Hey everyone, welcome back. We're diving into asset pricing today, specifically how people are using AI to try and predict stock returns. And you sent over some pretty dense research on this. Looks like really groundbreaking stuff.
It is really cool stuff. This research is uh, basically trying to solve this problem that investors have always struggled with, like how do we figure out which stocks will do better than others?
Yeah, like that's the million-dollar question, right? What
Yeah.
makes this different? What's the secret sauce?
Well, a lot of the old ways to do this, they used like historical data or some really simplified assumptions about how things work. And those don't really work that well in a market that changes as fast as ours does. And so what these researchers did was they combined this really cutting edge machine learning stuff, deep neural networks, with a really basic principle of economics called the no arbitrage condition.
Okay, so break that down for me. Deep neural networks. Like we're talking AI that crunches tons of data, right? But what is this no arbitrage thing? Yeah, exactly. So you can think of these neural networks as like super powerful brains that can learn all the patterns in huge data sets. And so what they did was they basically fed this network like 50 years of stock data, both like specific stuff about companies and then like broader macroeconomic trends. And so this no arbitrage condition that's kind of like a reality check for the model. Yeah. It basically makes sure that the AI isn't making predictions that would allow investors to get risk-free profits because like that doesn't really happen in the real world, right?
So they're like grounding the AI in real world economic principles. That's
Yeah.
really cool. So what data did they actually feed into this like AI brain we're building here?
Oh, they went all out. They took like 46 different factors for each company, and they looked at everything like their past returns, profitability, even stuff like investment levels and trading frictions, like how much does it cost to actually buy or sell a stock. And then on top of that, they added in macroeconomic data, so things like inflation, interest rates, even industrial production, all that, to try to like, capture the whole economic picture.
Wow, 46 factors for each company. Talk about thorough. But they didn't just like throw all these numbers at the AI, right? Like there's got to be some kind of method to the madness here.
Yeah, they got a little fancier than that. They actually transformed the data using quantiles. So imagine like lining up all the companies each month by a specific factor, like say profitability, and then you divide them all up into equal groups. And so a company's position within its group kind of shows how it's doing compared to other similar companies, which is really useful when you're trying to compare companies across different sectors and sizes.
So it's not like just about the raw numbers. It's more about like where a company ranks compared to its peers.
Right.
Okay, I get that, but I'm still stuck on this idea of a neural network, like learning from 50 years of data. What kind of neural network can even handle that?
So they actually combine two really powerful types of networks. The first one is called a generative adversarial network, or a GAN. So like picture two AIs going head to head. One is trying to predict stock returns and the other one is always trying to challenge those predictions by finding like the trickiest situations and portfolios. And this like AI versus AI battle helps the model to become super accurate over time.
Whoa, AI versus AI. That's
Yeah.
like some sci-fi stuff right there. But how do they deal with the fact that the market is like constantly changing? Past performance doesn't guarantee future results, right?
Right, and that's where the second type of network comes in. This one's called a long short-term memory network, or an LSTM. And this one is built to work with data that changes over time, like stock prices. And it actually has like a built-in memory, so it learns not just from a snapshot in time, but also from how the market has changed over time and how those changes have affected stock prices in the past.
Okay, so they've built this powerful AI model, trained it on decades of data, added that no arbitrage rule to keep it real. What were the results? Did it actually work?
That's what we'll get into next, but I'm kind of curious, what's been the most interesting part for you so far?
Yeah, so the results were really interesting when they tested it against like some benchmark models, including some that also used deep learning but didn't have that no arbitrage rule. This model did way better at predicting future returns.
So adding that like economic reality check really gave it an edge, huh? But I'm guessing it wasn't just about beating some other models. Like, what did it actually tell us about the market itself?
That's what's so exciting about it. This model wasn't just about predictions. It actually showed which factors were most important in getting those returns. So for example, it highlighted the role of trading frictions.
Trading frictions, like, what does that even mean? Like the cost of buying and selling stocks or how easy or hard it is to trade them?
Exactly. Those little details that you might not think about too much can have a big impact on returns, especially in the short term. The model also showed just how important momentum is, whether a stock is trending up or down, and something called short-term reversals, which basically means that stocks that have gone down recently tend to bounce back. So it's like confirming some of the things we already know about the market, but also potentially uncovering new insights. That's really cool.
Right. And maybe the most interesting thing was that they were able to find 4 different states of the economy
Hmm.
by looking at the LSTM
Yeah.
network.
Hidden economic states, it sounds kind of like economic astrology. What are these states and how do they affect things?
I know it sounds a little out there, but think about it this way. There are all these underlying forces in the economy that we can't always see directly, but they can impact how stocks perform. And so this model found 4 of these states that they think are connected to business cycles and times of economic crisis.
That's pretty mind-blowing. So like if you knew which state the economy was in, you could change your investments to match. That's what you're saying.
Yeah, that's the potential. Imagine being able to see market shifts before they have, like shifting to safer assets when the economy starts to slow down,
Yeah.
or taking on more risk when it's growing.
Okay. Yeah, I can see how that would be super valuable for investors, but hold on. If this model is so good at finding these states and predicting returns, wouldn't everybody start using it and wouldn't that advantage go away?
That's a good question, and it's something that comes up with a lot of these quantitative models. But the thing is, markets are always changing. There's always new information coming in, and even if everybody had this model, they would still need to figure out what it all means and how to use it. It's not like a magic solution. It's more like a tool that you need skill and judgment to use, right?
So it's more about understanding what the model is telling you and then using your own knowledge and experience to make decisions, right?
Right.
That makes sense.
Exactly. And that's where it gets really interesting. Remember those 4 hidden economic states we talked about? Let's dig into those a little deeper and see how understanding them could give investors an advantage.
All right, let's crack open these hidden economic states. What did they actually find?
Well, they gave them names like slow growth, high growth, market distress, and recovery. And each one is basically a different mix of like what's going on in the economy and how the market is acting. Like, for example, the slow growth state. That's when you have low inflation, moderate interest rates, and the stock market is kind of just plodding along.
So it's not just about, like, is the economy growing or shrinking? It's a bigger picture thing with all these different indicators and how the market is feeling about them.
Exactly. And the high growth state, that's probably what you'd expect, right? Strong economy, low unemployment, stocks doing great. But here's where it gets interesting. Even when things are generally good, the model says you can still have these little dips into these other states.
You mean like a sudden drop into market distress even when the overall economy is doing fine?
Yep, and that's why this is so cool. Market distress. That's when things get really volatile. Investors get scared, and stock prices can fall sharply, and it could happen because of something global, like a war, or maybe interest rates suddenly go up, or even just because investors are feeling spooked.
So even if the economy is doing okay, these like mini shocks can create chances for investors who know what they're doing.
Yeah, potentially, if you can see these shifts coming, you can protect yourself by moving away from risky assets, or maybe even make money from the downturn by short selling.
Short selling, that's a whole other deep dive. But I'm seeing how knowing about these states could give you a real leg up. Okay, so what about this recovery state? What happens then?
Recovery usually happens after a period of market distress. Things start to calm down, volatility goes down, and often stock prices jump back up as investors start feeling good again.
So if you can spot the start of a recovery, you could ride that wave and make some money from the rising prices.
That's the hope. Of course, timing the market perfectly is like almost impossible, but knowing about these states could definitely help you make better decisions.
Okay, this is all super interesting, but I gotta be honest, I'm still a little skeptical. How do we know these hidden states are real and not just something the model made up?
That's a valid question, and the researchers thought about that too. They tested the model by running it on historical data to see if it could correctly identify these states in the past. And guess what? It did a really good job matching the states with actual economic events and market trends.
So they're not just making this up, there's real data to back it up.
Exactly. For example, it always picked out periods of market distress that happened at the same time as big market crashes like the dot-com bubble bursting and the financial crisis back in 2008. And it also correctly spotted the recovery periods after those downturns.
Oh, that does make it seem more believable. But even if we agree that these states exist, how can regular investors use this information? I mean, we don't have access to this fancy AI.
True, but even without the model itself, there's still big lessons here. This research shows that it's not enough to just look at individual companies. You got to pay attention to the bigger economic picture, these macro forces that can really move the market.
So even with all the data and algorithms in the world, the big picture still matters.
Absolutely. And by keeping up with economic news, understanding how markets have moved in the past, and even just knowing about these hidden states, investors can make smarter choices and maybe even put themselves in a position to benefit when the market changes.
This deep dive has been amazing. We went from AI and economic theory all the way to practical tips for navigating the market. What a ride.
Yeah, it shows just how powerful it can be to combine cutting-edge tech with basic economic principles.
And for everyone listening, it's a reminder that staying curious, staying informed, and being able to adapt is key to winning in the world of investing. Thanks for joining us on this incredible journey.